Even before the coronavirus became an epidemic, this investment manager was cautious in regards toward the market. Gene Goldman is CIO with Cetera Investment Management, and he's joining us now from El Segundo, California, on the telephone. What was it that gave you pause before coronavirus set us into, at one point this morning, correction off the peaks?
Well, good afternoon, Adam and Julie. Thank you for having me on your show. Going into 2020, we were cautious. We've been cautious for a few months now. Part of it was fundamentals were a little weak. Also, valuations were close to 15-year highs. Fundamentals were weakening. We saw this point where the S&P 500 rallied about 35 to 40% since the end of 2018 with flat earnings growth. So you have fundamentals that aren't that great. You also have valuations that are near 15-year highs, pricing in absolute perfection. And we're also a big believer that, listen, valuations are pricing in absolute perfection. The other thing that concerns us is technicals. The market technicals, yes, there's a lot of momentum in stocks, but really focused on really large growth, those FANG names that are really driving market returns. All three of those, valuations, fundamentals, and technicals, really concern us in the markets already.
So going into this latest sell-off then, how were you guys positioned? Because we have seen selling pretty much across the board here. There haven't been too many places to hide in this market, except maybe treasuries and gold.
Yeah, and you're right about treasuries and gold. Treasuries, not exactly the best place to get into, or gold, just because both of them were near significant highs. We saw treasury yields today, the 10-year down to 127, lowest on record. Gold near, a 10, 12-year high. For us, how we repositioned our portfolios for our clients is we increased areas that are a little bit cheaper in the market, a little bit more small cap, a little bit more non-U.S., reduced our growth allocation. We also use alternatives. Alternatives are these investments that sort of zig when the rest of the market is zagging. Within fixed income, we definitely, where we did make a mistake, we did reduce our duration a little bit, but we really focused on bigger and better diversification within our portfolios. And the other area, broadly speaking, though, and something I do want to stress to your viewers and your listeners, is use the opportunity to rebalance back to your long-term investment objectives. This big bull market we've been in and we are in, you've seen this huge, significant outperformance of equities or bonds. And this created a scenario where if you're a 60-40 investor in March of 2009, today you're about 83% stocks, 17% bonds. You've basically changed your investment objective without doing anything in your portfolios. And this really concerned us as investment people.
Gene, what would you have to see to become more comfortable with putting fresh capital work in the market? Are you looking at technical levels? Are you looking at macro headlines? What is it that is your real variable here?
Unfortunately, we do need to see some improvement on the coronavirus news. We are concerned that companies continue to come out, not just pre-announcing first quarter earnings, but also pre-announcing 2020 revenues and earnings. That worries us. But for us to really kind of shift a little bit in the market, we do want to see some positives coming out of central banks. I know the Fed meets in 20 days, so ideally we've seen numbers suggesting that they may cut rates. We also want to see bigger capitulation in the market. Right now, if you look put the call ratios, they're not really capitulating yet. We don't see a lot of, a significant jump in puts versus calls. We also worry at the end of the last couple of days, you've seen a sell-off in the markets in the last hour. That worries us. So we become more bullish when we see investors say, I'm done, I'm giving up on this. That's a full-time capitulation. That's an investment opportunity for us.
Hey, Gene, it's Heidi here. So, yeah, we are off the lows of the session, and we have paired most of those earlier losses. But the S&P 500 did break below that 200-day moving average, and that spooked a lot of investors. So, in your opinion, are you a more buy-the-dip person here, or are you saying there's more pain ahead? We're headed to 3,000.
Hindsight that's a great question. Hindsight is 2020. For us, what we're watching, the key report coming out, we've been telling all of our advisors, Monday, we will see the ISM PMI manufacturing report. We did get the market flash report earlier this week, which suggests, it was the first look at February's economy, the first look at how the coronavirus is affecting the economy. Monday, we get a more true report. We'll watch that report. That's an important report. Monday's PMI manufacturing, Wednesday's PMI non-services report. Those two are going to be very, very key for direction in the market. We're watching them very, very carefully.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.